Silicon Valley Bank is a case study in predictability. And for that reason, it makes sense for us to go back, revisit, and think about Silicon Valley Bank one more time. In order to look at it, I'd like to just put it in a bit of a context. And I think the starting point is to look at what companies typically do today in order to predict their business. And the simplest example is by looking at the way that STARTRADER operates, how we predict our business. And from that, I'd like to broaden out predictability into how difficult that is, and then go into the financial landscape in which we operate and in which Silicon Valley Bank did operate, and then go into that hair-raising period when Silicon Valley Bank was crushed by not being able to predict what would happen next. Background on STARTRADER, well, we serve markets where 5 billion out of 8 billion people live in the world today. We're a CFD broker. If you want to trade, we can help. That's what we do. And we've rolled out our services in many countries across the world. Each country has its own payment services. All of these payment services are unique. So we have about 200 payment services providers today that we're connected into. That's quite complicated because that means 200 ways to withdraw money and 200 ways to deposit money. 400 processes. The way that we've done that is by first implementing very quickly and then doing process mining to understand what we're really doing, and then dovetailing that into the way that all the other payments are done so that we can operate at scale efficiently. We want to make payments fast, both in and out. And if we don't understand what we're doing, then of course, that's not possible. And as we add more and more payment channels, if we don't understand how the other ones work, then we'll create a mess. So doing this right and using AI for process mining is central to scaling STARTRADER. We have the same when it comes to institutional clients. We have a lot of big customers who come to us, and they come to us for many reasons, partly because of high flow, market depth if you prefer. They like us because if they want to make a big withdrawal, then that's no problem. So we're strong enough from a capital standpoint, so that's good. They like our risk management, and indeed we give training to other brokers and to big institutional clients about risk management. So those are all areas that we operate all the time. And when we bring people on board, we think very hard about the transaction intelligence that we need. So we do non-linear stressed forecasting. We do variable extractions in order to understand what causes what. We don't want correlation, we want causation if we're going to control the system. And anomaly detections. Every now and again we get something odd, and in that case we want to spot that quickly and analyze it accurately. So those are AI techniques, machine learning techniques that we're using in our day-to-day business in order to understand what's going to happen next. Important things. So that's for our little company. Well, is this prediction stuff really that difficult? The answer is yes, obviously. If you think about cars, then when motor cars were introduced a bit more than 100 years ago, the first order effects of needing roads to drive on were easy to predict. But the second order effects of architecture were not easy to predict. Urbanization, Los Angeles with its enormous sprawl of houses all over the place, those were things that people did not predict. And we didn't predict them because of a lack of intelligence. People 100 years ago, and indeed 200 years ago, were just as intelligent as we are today. But it was just beyond us. We're not smart enough to predict that that's what's going to happen. And we have similar effects with the Industrial Revolution. When that first happened with steam and coal and all those good things that enabled us to make our lives more convenient and safe and secure from a food perspective, we did not predict at the time that we would raise the Earth's temperature. And going forward, we can't predict what's going to happen. We don't know what global warming will do next. Even today, we don't know the effects of the Industrial Revolution. We don't know if it will reverse El Niña, reverse the Gulf Stream and cause another ice age. We don't know. We can guess. And a lot of us even today don't believe that global warming is even happening. So our ability to predict the effects of the industrial age has been fantastically poor, and just as bad as our ability to predict the future of the car. So that will continue. If we look at the internet revolution, and then when that came along 30 years ago, we did not predict that today 70% of teenagers have been bullied online. 70% of teenagers have been bullied online. We didn't see that one coming. Not because we were less intelligent 30 years ago. It's just that we couldn't predict it because we're not clever enough. And similarly, when the first games came out, I remember playing Tetris, we did not predict that the top gaming platforms today would be a fertile ground for radicalizing people into thinking things that they just wouldn't think otherwise. Again, we didn't predict it when those games came along. With AI, well, first of all, we are who we think we are. But if AI is selecting the information that I consume, recommending articles and so forth, then my ability to control the things that affect the way I think about the world and how I think about myself is something that I give away the control for those things. So we are who we think we are, and by giving away control about what influences us, we're giving away control of who we are. That narrative is key. Our children will have friends recommended to them by AI. Some of those friends will be real, some of them will not be real. I don't know which one is more scary. AI will recommend friends to all of us over the next year. Some of us will say yes to these new friends. And now we have friends who shape us. And we've given away control of selecting those friends. So AI will change who we think we are. AI will change the United States presidential election in 2024. We didn't predict that a couple of years ago. That's not because we were less intelligent a year ago or 4 months ago. It's just we have our limitations. And I say these things because when it comes to Silicon Valley Bank or SVB, they operated without real-time data about their securities portfolio. Now, if you're operating a business and you don't know the economic basis on which you're operating your business, how can you predict what the future predicament will be for that company? This is dangerous stuff. So let's put this into more context. In 2007, 2008, we had the global financial crisis. And over the years afterwards, we responded by printing incredible amounts of money, and we called it the quantitative easing. And the big idea with this QE, or quantitative easing, was to feed investment. That's what we wanted to do. And it doesn't quite work out that way. And the reason it didn't work out that way was because the QE money ended up sitting in bank accounts, and the banks in whose bank accounts this money sat used that money as security for providing loans many times bigger than the initial QE, which meant that the primary source of money was not from the governments who provided the QE, but actually from the banks who used the QE as security for loans. The resulting amount of money was so huge that it didn't fit into companies who wanted investment. Instead, most of the money went into housing or real estate and into shares. That's not what was intended, but that is what happened. Some of it went into investment, but most of it went into housing and shares. Now, the quantity of money that went out was consequently at a level which is difficult even today for us to understand. What we see now and what we started seeing in 2020, I think Turkey was the first country in 2018 who saw this, is that a small percentage of that money that went into real estate and shares is now leaking into consumption. It's leaking into the things that do make up consumer price index or CPI. It's leaking into inflation. Real estate and shares are not part of inflation indexes, so that's been kind of hidden until now. And in 2020, that was apparent. All over the world, we started seeing countries where inflation was rising. And in 2021, we saw the first examples of quantitative tightening, where central banks thought, okay, inflation is rising. It's my job to keep inflation at 2%, so I'm going to raise the interest rate. Unfortunately, raising interest rate is not the same as keeping it on the floor. By raising interest rates, the people who are primarily hurt are companies who choose not to take loans. So there's an asymmetry there between quantitative easing and quantitative tightening. The central banks have the sharpest people on this planet for predicting this, and it was beyond our best people at the central banks to predict this asymmetry and how it would strike. Prediction again. Even with the best AI, it's today not possible to make that type of a prediction. We don't have the tools, and we certainly don't have the people to make those predictions. In that context, let's look at how banks operate and operated in 2020. Well, the big idea is simple. You get depositors who deposit money, and you pay them a very low interest rate, and you take that money and you put it into bonds and long duration securities with a slightly higher level of interest, and boom, you have a profit. It's a very small margin business to be a bank in a traditional sense. That's the world in which the banks did operate and where they do operate today. Now, when you go for those long duration bonds and securities, you are dependent on the interest rates remaining low, or at least below the yield that you're experiencing from those bonds and securities. That's, after all, your business. You've borrowed money in order to buy those things, so in many cases. So you need to be really tight, really, really tight. That's the general picture. In order to manage that, banks typically hedge heavily for changes in interest rate so that they're resilient in case problems arise. Let's look at Silicon Valley Bank 2021. Everything was nice. In a short period of time, Silicon Valley Bank had grown to a situation where at the end of the fourth quarter in 2021, Silicon Valley Bank had $189 billion of deposits, Now that's a big number because if you put it in context, let's think about the Russian invasion into Ukraine. The total cost of that war so far is somewhere between $300 and $400 billion for both sides. So Silicon Valley Bank alone had money which totaled roughly half the price of that war. So that's a lot of money. And Silicon Valley Bank was feeling nice and secure. The people who had deposited the money consisted primarily of venture capital backed companies, startups in the Bay Area, San Francisco. And everything was nice. Most of the money sat in long duration bonds at 1.64%. And of course, in the year 2020, 1.64% was a high interest relative to 0% from central banks in many countries. Feeling pretty good, feeling pretty safe. And the CFO, Daniel Beck, underlined that everything is safe, lots of security. 2022 came along and Silicon Valley Bank experienced a perfect storm. Partly, the Fed started raising interest rates in the second half of 2022, and partly the venture capital community pretty much dried up in the Bay Area in 2022, which meant that the startup companies that had their money in Silicon Valley Bank were burning through their cash. And when they burned through their cash, they withdrew from the bank and spent the money. So the deposits started going down at the same time as the interest rates started going up. Not nice. The response by Silicon Valley Bank was phenomenal. In April of 2022, on the 29th of April, the chief risk officer left Silicon Valley Bank and was not replaced during 2022. Now that doesn't seem like the best solution to a crisis. And in August 2022, the CEO, Greg Becker, underlined that Silicon Valley Bank is safe. 30 years of experience and so forth. And additionally, in the second quarter of 2022, Silicon Valley Bank sold its hedged positions that were supposed to safeguard Silicon Valley Bank against rising interest rates, thereby creating a second quarter result that was very nice. And I hope that everyone was able to withdraw a good bonus, because when things got worse in 2022, there was not much margin left. And indeed, a new chief risk officer was appointed and joined the company on the 4th of January 2023. I don't know exactly who decided what. Surely the CEO must have been part of it and the chief risk officer must have been part of it. But on the 8th of March 2023, they took action. They realized that they absolutely need more money in the business. So they requested capital. They did a raise. They wanted to sell shares, common equity to the tune of $2.5 billion, get more money in the business, hoping to get private investment and issuing convertible bonds. In doing so, they were obliged to disclose their financial position to a much greater extent than before, which meant that they had to disclose that they lost $1.8 billion when they sold most of the available for sale long-term assets, or AFS assets that they had. So that was a bad situation. Asking for money is one thing. Disclosing that you've lost 1.8 billion without telling people is another thing. They did those things in the evening of the 8th of March 2023, hoping to keep it rather quiet and just get the job done. I presume. I don't know. It's a post-close statement. The reaction overnight was really strong, and we could see things on our trading platform immediately, that things were going on. And on the 9th of March, full action. Share price down. Thursday, the 9th of March, share price down 60% in a day. Now that's in a big company. Losing 60% of your share price in a day for a big company is a big thing. And the clients of Silicon Valley Bank were primarily highly tech-savvy startups and VCs. So they just picked up their mobile phones and swiped out $42 billion of deposits. And venture capital companies like Canaan, Coatue, Union Square Ventures and Founders Fund advised their startups to take their money out because they didn't believe in this anymore. $42 billion were withdrawn in one session, one day, from Silicon Valley Bank. It's simply incredible changes. And again, we saw changes in the market. Traders were trading all over the place within StarTrader during this time period. Friday the 10th of March came along. And during that Friday, the share price went down 69%. And the bank closed. In the morning of that Friday, the CEO, Greg Becker, said, come on guys, just leave your money in the bank and we'll be fine. And people didn't believe him anymore. He had lost his credibility. And the bank went down. And with it, a couple of days later, you saw other banks come down as well, such as the Signature Bank and so forth. Now, was this predictable? No. Some of it was, of course, foolishness and greed, maybe. I don't know. But a lot of it was not predictable. The way that the interest rate rises would come from the Fed was not predictable. The resilience of Silicon Valley Bank was not predictable for an outside investor. The information had not been disclosed. What should we do in the future? Well, from a regulator standpoint, I don't know. Maybe we should have a simplified regulatory framework where defined companies who choose to be active in this line of business make deposits with the central bank, and then when those deposits are used in some way for bailouts and so forth, then there's a predefined haircut mechanism that kicks in. That seems to make sense. Sorting these things out during calm days is the right thing to do. So far, when these crises have hit, both the 2007-8 one and this one, the reactions have been spot reactions. They've been sudden reactions, which of course is the wrong ways to solve things. If you enter into a contract, then you should negotiate the downside when you're friends. You should not wait until you're enemies and then start to negotiate, because that creates acrimony and very great difficulties. So many lessons to be learned. Also from an investor standpoint, when we invest in banks or bank-related assets, we need to understand that banks are not like other companies. They are connected, they are not disconnected. Everything is connected to everything when it comes to banks. So banks cannot be allowed to fail in the normal way. Sometimes maybe they're allowed to fail, but sometimes not. So the predictability there, again, from an investor standpoint, is difficult. I think as an investor during this time, we should assume that the market is distorted and will remain distorted for quite some time, because the ability for central banks to do quantitative tightening is more difficult than foreseen. Silicon Valley Bank is an example that proves that. Consequently, future efforts to do quantitative tightening are again going to be very difficult. So we're going to see volatility. We're going to see two things. One, we're going to see that money remains in the market to an extent that we had not thought previously. Maybe that will mean continued high inflation for an extended time period. What are the second order effects? Well, I've lived in London for most of my life, and we're seeing immigration coming into the UK at a level of 1% or above of the population per year right now. Now, those levels of immigrations are very high compared to what was promised a few years ago. Why? Well, the level of inflation in the UK over the last couple of months has been in the region of 10%. Now, if you buy an £800,000 house in England, and if you pay a £200,000 deposit on the house, you borrow £600,000. If the inflation is at 10%, then your cost of capital is such that your monthly payment for your house is going to be in the region of £7,000 per month. £7,000 per month means that that's from a net salary. Your gross salary needs to be at a level which is not realistic for most people. Consequently, you can't buy an £800,000 house, but most houses that are 2 up, 2 down in desirable urban areas are in that region. Well, if you don't do something, then the house prices are going to crash magnificently. You have elections coming, maybe in 18 months' time, or maybe more or less. We don't know exactly when. Those elections are going to be a disaster if the house prices go down by 20%. So how are you going to fix that? Well, one way of fixing that is by taking in 700,000 new people into the country who have lots of money and keep up the demand so the house prices don't crash. Now, those are second order effects that we would never have thought about when QE first started. This is totally unreal. So I think the unpredictability is going to continue. We don't know what's going to happen. Now, from an investor standpoint, this is, from a trader's perspective, this is very interesting. Let me take one more example of unpredictability. One thing that's happened over the last year or two is that celebrities are increasingly getting involved in pumping assets up, down. Now, I play tennis. I play tennis badly, and I play it often. Now, Naomi Osaka is on this list of people. I love the way she hits her forehand. It's beautiful. Her top to back spin, her kick serve has a snap to it, which I adore. I'd love to spend a couple of hours with Naomi just understanding how she does those things. But I politely and humbly, I don't want Naomi Osaka to be my financial advisor because she's a tennis player and not a financial specialist. I have other people for that. But these guys are getting involved in financial advice. I think that's amazing. And now that will drive volatility in the marketplace as a whole. So you have volatility coming from random places like the ones I just described. On top of that, you have raw money coming in. President Biden here has pledged $1.2 trillion into the Infrastructure Act. Now, that's so much money, it's going to have an effect on companies all across the world who sell the machines with which that infrastructure will be built. $280 billion on the US CHIPS Act. Again, semiconductors, batteries, manufacturing, that's going to have an effect worldwide. It's so much money. And on top of that, we have $400 billion pledged for inflation reduction. Now, I'm a little bit old-fashioned. Exactly how you're going to print money in order to reduce inflation is something that remains a bit of a mystery to me. It's not clear to me how that quite works. Perhaps President Biden or someone who is financially well educated, perhaps they can help explain that. From my perspective, this looks like a combination of incredible amounts of money going out and volatility being added to the soup because of the contradictions that are inherent in this. Where is it going to go? Well, I don't know. Looking at the picture as a whole, I can only conclude that traders should be smiling. If there's no money, then it's not interesting to be a trader. if there's no volatility, it's not interesting to be a trader. Now, money and volatility. Okay, so 2023 and 2024 look like maybe the best 2 years ever to be a trader. Welcome, grab your account. I don't know which one you're using. Maybe you're using an ECN account, maybe using a standard account, maybe a cent account. In all cases, pick your planet, land. If you haven't done it yet, please do register. We, of course, need to do full KYC and AML on you so that we understand who we're dealing with. We're a fully regulated company, so take the pain and go through registration, come on board, and join us, and let's have fun in the marketplace. Thank you very much, and I hope to see you again.